Constellation Energy, ticker CEEG. They just dropped their Q2 numbers, and it is a wild ride on paper. Let's just hit the numbers cold. Adjusted operating earnings absolutely crushed it at $2.55 per share. That beat the 236 consensus. Revenue came in at $7.5 billion, which, depending on whose desk you follow, was either a slight miss against the broad consensus or a beat if you track Zacks' more conservative $7.47 billion target. But the kicker? They hiked full-year guidance to $11.50 to $12.50 per share, and the stock drifted up nearly 7% in the week after the print.
Yeah, the market completely bought the narrative. But we really need to talk about that GAAP net income number before everyone just victory laps this stock.
Right, because the JAP numbers fell off an absolute cliff.
Exactly. I mean, they dropped down to $513 million. That's $1.42 per share, down from over $800 million a year ago. It's a massive divergence. You got adjusted earnings soaring, but official GAAP profit is just in the basement.
It's enough to drive you crazy if you're holding this in your portfolio.
Yeah.
It's like looking at an open house, right? The curb appeal, the adjusted EPS, looks stunning. Fresh paint, great landscaping. But then the structural inspector goes down into the basement and sees these massive foundational cracks. How are they doing so well and so poorly at the exact same time?
Well, I'd push back on the structural failure analogy a bit. It's not a crack in the foundation. It's more like the incredibly messy reality of building a massive new addition on the back of the house.
Okay, the Calpine acquisition.
Right, the Calpine deal. When you absorb an entity of that size, you get hit with all these accounting charges that just do not reflect the daily cash-generating power of the actual business.
Like the fair value losses and the amortization of acquired contracts they mentioned in the 8K?
Exactly. Because Constellation operates heavily in competitive wholesale markets, they hedge their power prices. When energy prices fluctuate, the paper value of those hedges changes. It triggers a temporary loss on the balance sheet, even if, no actual cash left the building.
It's just mark-to-market noise.
Right. And the amortization is similar. They bought Calpine's existing customer contracts, and accounting rules force them to spread that cost over time. It's a paper expense. The adjusted earnings strip all that out to show you the core cash coming in the door.
Which is what Wall Street actually cares about.
Yeah, exactly.
But you can't just wave away the balance sheet changes, right? Because they took on a ton of leverage to make that Calpine deal happen.
Oh, the structural transformation is breathtaking. Total assets exploded to over $98 billion. But, as you said, the liabilities went right along with it. At the end of 2025, they had about $7.25 billion in long-term debt.
And now?
By June 30th, that skyrocketed to $19.11 billion.
$19 billion. I mean, if you're a retail investor, that should give you some pause. You're basically buying a sprawling mansion on a credit card. Sure, you have more space, but in this interest rate environment, your monthly sensitivity is terrifying. Servicing $12 billion in new debt eats into your cash flow fast.
It does. And institutional investors were aggressively pointing at that exact vulnerability. But management came prepared. They initiated a really aggressive capital allocation pivot to counter the debt concerns.
The buybacks?
Yeah, $2.2 billion in share buybacks already deployed year to date. And they just authorized a total of $5 billion for future repurchases.
Which is just the ultimate signal of confidence. Management is looking at the market, looking at their extra $12 billion in debt and saying, we still think we're undervalued. We're buying our own stock.
Exactly. It forces the market to trust their free cash flow projections.
Yeah.
And they aren't just relying on operating cash. They're selling the Brazos Valley Energy Center to LS Power for $860 million.
Though, to be fair, the DOJ forced that sale for antitrust reasons, right?
They did, yeah. When you get this big, regulators won't let you own too much generation capacity in one region. But honestly, it works in Constellation's favor. It brings in nearly $1 billion in liquid capital to pay down that newly bloated balance sheet.
Right. It cleans up the leverage ratio.
Yep. And all this financial maneuvering, the debt, the buybacks, the asset sales, it's all just setting the stage for their real growth engine.
Which is why the stock popped 7%, despite the messy top line and the gap drop. Wall Street is looking entirely at the artificial intelligence sector.
Oh, 100%. It is the only reason you raise your full-year guidance by 50 cents mid-year. You don't do that unless you have extreme visibility into your revenue.
Because tech giants are absolutely desperate for clean baseload power for these data centers, and Constellation is sitting on this massive nuclear fleet running at, what, a 93% capacity factor?
93%, yes, which is unheard of for renewables like wind or solar.
Right, because the wind stops blowing. AI data centers cannot stop. They need 24/7 power, and Constellation just locked in an additional 920 megawatts of long-term nuclear PPAs in Q2 alone.
And look at the duration of those contracts. They're averaging 18.5 years.
That's incredible.
It is. I mean, an 18-year power purchase agreement with an investment-grade tech company. The CFO basically knows exactly how much cash is clearing the bank every month until 2045.
And the broader context here is just staggering. I mean, McKinsey estimates global AI data center capex will hit $7 trillion by 2030. FERC thinks U.S. data center electricity demand will double to 35 gigawatts.
The demand curve is almost vertical.
Yeah, and you see it in the filings. Amazon did that massive deal with Talon Energy. Meta just signed a 1.1 gigawatt deal with Constellation in Illinois. But the wildest one to me, and this is driving so much of the premium, is Microsoft basically paying to revive 3 Mile Island.
The Crane Clean Energy Center, yeah.
I mean, walking up to a dormant, decommissioned nuclear reactor and saying, turn it back on. The engineering and the red tape for that must be a nightmare.
It's an incredibly steep hill. But Constellation is clearing these hurdles way faster than anyone modeled. They just got a FERC waiver to transfer the existing capacity interconnection rights to the Crane facility.
So they basically get to skip the line for a grid connection study.
Exactly. The plant used to operate, so Constellation argued they already own that physical permission slip to push power onto the grid, and FERC agreed. Plus, the NRC just approved their fuel license.
Wow.
Yeah, the federal government verified their safety protocols and storage capabilities. So they are firmly on track to restart that reactor in the second half of 2027.
Which totally explains why management is targeting 20% plus base EPS growth through 2029.
That's a total paradigm shift.
Great, utilities are supposed to be boring. You hold them for a safe 4% dividend growth. 20% EPS growth decouples them completely from the utility sector. They are trading like an AI infrastructure stock now.
Nuclear went from a toxic legacy liability 10 years ago to the single most valuable commodity in Silicon Valley.
But okay, let's play devil's advocate for a second. We've talked about the beat, the PPAs, the AI demand. What derails this? What is the actual risk to that 20% growth target?
The biggest threat isn't demand, and it isn't Constellation's execution. It's regulatory gridlock at FERC and PJM.
Okay, the wholesale market regulators.
Right. There was a massive fight brewing over how these tech companies want to access this tower. They are pushing for co-located or behind-the-meter data center loads.
Meaning they build the server farm right on the nuclear plant's property. They plug straight into the reactor and bypass the public transmission grid entirely.
Physically, yes, it's highly efficient, but regulators are panicking. The public grid was financially modeled on the assumption that this massive nuclear capacity would be available to everyone during peak demand.
Like during a heat wave.
Exactly. If PJM calls on the plant to keep the lights on in millions of homes, but a full gigawatt is legally diverted to a private Meta or Microsoft server farm.
The grid operator can't use it.
Right. And worse, who pays for the public grid upkeep? Maintaining poles, wires, substations costs billions. If the biggest corporate users bypass the grid, everyday consumers are left footing the entire bill.
Oh, wow. So FERC might step in and say, no, you have to pay massive grid connection fees anyway, even if you're behind the meter.
Exactly. If regulators re-rate the economics of these hyperscaler contracts to protect the public grid, Constellation's lucrative profit margins could shrink overnight. It's the hidden linchpin to this entire AI nuclear story.
That is fascinating. So for anyone tracking CA, you have to watch those FERC and PJM dockets.
You have to. A favorable ruling sends the stock higher, but an unfavorable one forces Wall Street to completely rethink these growth projections.
So let's wrap this up. Constellation had a messy Q2 on paper. Massive debt surge to $19 billion from the Calpine deal. GAAP income took a hit. But beneath the top-line noise, the cash generation is a machine. They're buying back $2 billion in stock, raising guidance, and basically selling every spare megawatt of nuclear power to big tech for the next 2 decades.
It really highlights a profound physical shift in our infrastructure.
Yeah, and it leaves you with a really unsettling question. If trillion-dollar tech companies lock up all the reliable, carbon-free nuclear power for their AI models until 2045, what happens to the rest of us?
Right. Do everyday communities get stuck relying on dirty fossil fuels or intermittent solar just because they can't outbid Amazon for a nuclear contract?
It's wild to think about. The AI boom is literally reshaping who gets the privilege of using the world's cleanest energy. Definitely something to keep an eye on for your own portfolios and honestly, just as a consumer on the grid. That wraps up our deep dive on Constellation Energy's Q2. Make sure you follow the show. We're doing these daily earnings recaps, cutting out the fluff and getting straight to what actually moves the markets. We'll see you on the next one.
Yeah.